What is going on, everyone? Welcome back to the channel. I'm your host, Alex Morgan, and if you are watching this right now, you already know that the stock market is sending some very serious warning signals. We are talking red futures, a falling S&P 500, fresh tariff chaos out of Washington, an inflation reading that just refused to cooperate, and all of this happening in the same week that Nvidia is set to deliver what could be the most important earnings report in years. So yeah, today's video is going to be a meaty one, and I am not going to waste a single second of your time. Before we get into all of that, and trust me, we are going to go deep today, I need you to do one thing for me right now. Hit that subscribe button and ring that notification bell so you never miss an upload. Every single day I bring you fresh, data-backed stock market analysis, no fluff, no speculation dressed up as fact, just real numbers, real trends, and real talk about where your money stands. All right? Great. Now let's get into it. Let's start with where the market stands right now, on Monday, February 23rd, 2026. As of this morning, U.S. stock futures are already sliding before the opening bell even rings. Dow Jones futures are down roughly 0.4%, S&P 500 futures are off around 0.5%, and Nasdaq 100 futures, home of your biggest tech names, have dropped close to 0.7%. This is not a random blip. This is the market waking up to a whole new set of problems after a deceptively decent Friday. Because here's what happened last Friday. The S&P 500 closed at 6,909, up 0.69%. The Nasdaq finished at 22,886, up about 0.9%. The Dow Jones added 230 points to close near 49,625. On the surface, that looks great, right? But here's the thing, and this is what most channels are not telling you. Those gains were built on a very shaky foundation. And over the weekend, that foundation developed some serious new cracks. Let's talk about the biggest headline over the weekend because this one is critical. On Friday, the Supreme Court actually invalidated a broad chunk of Trump's trade agenda, and the market initially loved that. Traders saw it as a signal that the tariff storm might be calming down, but then, and this is classic market whiplash, over Saturday, President Trump announced he would raise the baseline tariff rate on imports from 10% all the way to 15%, effective immediately. Now, whether the formal executive order has been signed yet is still unclear as of this morning, but the signal is out there and the market is reacting. Why does this matter so much for stocks? Because tariffs are essentially a tax that gets passed along the supply chain and ultimately hits corporate profit margins. When companies pay more to import goods, materials, or components, their costs go up. And if costs go up faster than revenue, earnings estimates come down. And when earnings estimates come down, you guessed it, stock prices follow. The sectors most exposed here are consumer goods, industrials, and semiconductors, since a huge portion of their supply chains run through international partners. So if you're holding positions in any of those areas, you need to be paying very close attention right now. Now let's layer in the economic data, because this is where things get really interesting, and honestly, a little worrying. The government just released its first estimate for Q4 GDP, and it came in at just 1.4% annualized growth. Wall Street's consensus was expecting around 3%. That is a massive miss. We are talking about economic growth running at less than half of what analysts predicted. That is the kind of number that gets people whispering the R word, recession. But here's the cruel twist. And this is what makes the current environment so uniquely challenging for the Fed and for investors. While growth is slowing down, inflation is still running hot. Core PCE inflation, which is the Fed's preferred inflation gauge, came in at 0.4% month over month. On a yearly basis, it's sitting at 3.0%. The Fed's target is 2%. So we are still a full percentage point above where the Fed needs inflation to be before it can even think about cutting rates. As one analyst at Schwab put it, with economic growth at or above trend and inflationary pressures still very much present, the Fed is expected to stay on hold until we see more persistent signs that inflation is genuinely cooling. What this creates is what economists call a stagflation-light scenario, not the full 1970s version, but a situation where growth is disappointing and inflation is stubborn at the same time. For the stock market, this is genuinely one of the worst environments to be in because the normal playbook breaks down. Normally, if growth slows, the Fed cuts rates, cheap money flows into stocks, and the market recovers. But when inflation is still elevated, the Fed can't cut. And so that safety net disappears. Investors are essentially flying without a parachute. Now let's zoom out and look at the S&P 500 itself from a valuation standpoint, because the numbers here are eye-opening. As of this morning, the S&P 500 is trading around 6,861, already down about 0.7% from Friday's close. Over the past month, the index has dropped around 1.28%, but here's the thing. It's still roughly 14.7% higher than it was a year ago. So we are not in a crash, not yet, but we are absolutely in a phase of serious deterioration. Here's what worries me most about the valuation picture. Analysts are forecasting S&P 500 earnings to grow by 15% in 2026, which would be the fastest pace in 5 years. That's actually a bullish number, but the market is already priced at 21.5 times forward earnings. The 5-year historical average is 20 times. So the market is trading at a premium to its own history, based on earnings growth projections that still have to actually materialize in an environment of tariff uncertainty, slowing GDP, and sticky inflation. That is a very thin margin for error. If those earnings projections start to get revised downward, and with tariffs going up and GDP going down, they very well might. This market could reprice very quickly. Let's talk about tech and AI because this is the sector that everybody is watching right now. Wednesday is Nvidia earnings day, and I cannot overstate how big of a deal this is. Nvidia has been the single most important stock in the AI trade. It is the bellwether. If Nvidia delivers a strong beat and raises guidance, it could provide a lifeline to this entire market and reignite confidence in the AI narrative. But if it disappoints, even slightly, we could see a very painful sell-off, not just in Nvidia, but across the entire tech sector. What makes this moment so tense is what's happening in the broader software sector. Names like Salesforce, Oracle, and ServiceNow, which were market darlings just a year ago, are down anywhere from 20% to 30% year to date. The reason? There is a growing fear on Wall Street that AI tools are going to erode the business moats of traditional software companies. Why pay thousands of dollars per seat for a CRM platform when an AI agent can do the same job for a fraction of the cost? That disruption thesis is gaining steam, and it's hitting valuations hard. And speaking of AI disruption, there's a new risk that appeared on the radar this week that not everyone is talking about yet. Blue Owl, one of the largest private credit funds in the country, has halted withdrawals. Now on its own, that might seem like a niche financial story. But analysts are beginning to worry that this could be a canary in the coal mine moment. Private credit funds have significant exposure to software companies, the exact same companies being threatened by AI disruption right now. If those software valuations continue to fall, private credit portfolios could face serious stress, and that stress could ripple outward into broader financial markets. This is a situation I am going to be watching very carefully in the coming days. We also cannot ignore the geopolitical dimension right now, because it is adding another layer of uncertainty that markets hate. Tensions with Iran have been escalating, and there are genuine concerns that the administration could be considering military options as nuclear negotiations remain stalled. Iran-related talks are scheduled to resume in Geneva on Thursday, which gives the diplomatic track one more shot before markets start pricing in something more serious. Historically, geopolitical flare-ups in the Middle East tend to spike oil prices, which feeds directly back into inflation, which, as we just discussed, is already the Fed's biggest headache. Speaking of commodities, gold is currently trading around $5,044 per ounce. Let that sink in for a second. $5,000 an ounce. That is a number that reflects deep investor anxiety. Gold is the world's original safe haven, and when it is this elevated, it tells you that a lot of very large, very sophisticated investors are hedging against something serious. Meanwhile, WTI crude oil is hovering near $66 per barrel, not panic territory, but sensitive to any geopolitical escalation. If you see oil start to spike past $75 or $80 this week, that is a warning signal that you should take very seriously. Let me give you a quick rundown of what is on the calendar this week, because timing matters when you're positioning your portfolio. Today, Monday, we get earnings from Domino's Pizza and Dominion Energy during the day, followed by Diamondback Energy, Hims and Hers Health, and Keysight Technologies after the bell. Tomorrow, Tuesday, Home Depot reports. And Home Depot is important not just as a stock, it's a barometer for consumer spending and housing activity. If Home Depot's numbers disappoint, it tells us the American consumer is pulling back, and that has broad implications for the entire retail sector. Then Wednesday, the big day. Nvidia reports after the close, and Salesforce also drops earnings the same evening. That is a 1-2 punch that could either stabilize this market or send it into a much deeper correction. I'll be doing a dedicated breakdown video Wednesday night or Thursday morning, so make sure you are subscribed and have that notification bell on so you don't miss it. Now here is the part that everyone wants to know, and the part I'm going to give you straight. What happens next? What direction is this market likely to move? Let me break it down into two scenarios, because right now the market is genuinely at a fork in the road. Scenario 1, the bull case. Nvidia comes in Wednesday with a massive earnings beat. They raise guidance on AI chip demand. The market reads that as confirmation that the AI growth story is still fully intact. Simultaneously, the Geneva talks on Iran go well, and oil stays below $70. Tariff noise calms down as businesses adapt to the new 15% baseline and begin lobbying for exemptions. In this scenario, the S&P 500 finds a floor around 6,800, bounces back towards 7,000, and the broader bull market resumes, albeit at a slower pace. This is possible. It's not the most likely outcome right now, but it is absolutely on the table. Scenario 2. The bear case. Nvidia's earnings are in line or even slightly above expectations, but the guidance is cautious. Management mentions demand softness or pricing pressure. The AI trade, which has been the single most important driver of this bull market, starts to crack. Meanwhile, tariffs begin showing up in corporate earnings warnings across industrials and consumer goods. Inflation stays sticky, the Fed holds rates, and investors realize there is no cavalry coming. In this environment, prediction markets are already putting the probability of the S&P 500 dropping to 6,200 or below at some point in 2026 at 58%. That means more than half the market believes we could see a 9% to 10% correction from current levels before the year is out. My personal read on this, and I want to be very clear that this is analysis, not financial advice, is that we are in a high-risk, choppy, event-driven market. The next 72 hours are going to be enormously revealing. Nvidia either saves the AI trade or it doesn't. Iran talks either calm the geopolitical temperature or they don't. Tariff clarity either emerges from the White House or it doesn't. And historically, when this many major variables are unresolved simultaneously, markets don't tend to rally hard. They tend to drift lower with violent spikes in both directions, which is exactly what we saw in the second half of last week. So what should you actually be thinking about as an investor right now? A few things. First, cash is not a dirty word. In an uncertain environment, holding a little more cash than usual gives you the optionality to deploy capital when the picture becomes clearer. Second, sector rotation matters. Energy stocks and commodity producers tend to hold up better in inflationary environments. Gold and gold mining stocks have been on an absolute tear, and that trend has not shown any sign of reversing. Third, and this is critical, watch your software and high-growth tech exposure very carefully. That sector has been the most vulnerable to AI disruption fears, and it has further to fall if Nvidia disappoints. Fourth, do not make emotional decisions based on a single day of movement. The market is going to be noisy this week. There will be red days and green days and a lot of panicky headlines. Your job as an investor is to stay anchored to your time horizon, your risk tolerance, and the fundamental data. Panic selling at the bottom of a correction has destroyed more wealth than any market crash in history. And buying the dip blindly on every red day in a deteriorating macro environment is equally dangerous. Discipline is everything right now. All right, guys, that is your full stock market breakdown for February 23rd, 2026. We covered the slipping futures, the GDP miss, the sticky inflation reading, the tariff shock, the AI sector risk, the private credit warning from Blue Owl, the geopolitical pressure from Iran, and I gave you both the bull and the bear scenarios for where this market heads from here. The next few days are going to be decisive, so stay sharp, stay informed, and stay disciplined. If you got value from this video, and I know you did, please give it a thumbs up right now. It takes 2 seconds, and it genuinely helps this channel grow so I can keep bringing you this level of daily analysis completely free. And if you are new here, welcome. I'm Alex Morgan, and this is what we do every single day. Cut through the noise, bring you the real data, and give you the analysis you actually need to make smart decisions with your money. Hit subscribe, hit the bell, and I will see you in the next one. Take care.